Hi guys, my name is Noah Richardson. My topic to present on was REITs. So we're going to be talking about that. REIT stands for Real Estate Investment Trust. Essentially, a REIT is a company that will buy or manage various properties in real estate, many properties that hopefully generate a positive cash flow. It began in 1960 as an act of Congress, and it mimics mutual funds because as I just said, they are involved in many different properties, many different investment opportunities, and as shareholders, we can invest and buy stock in these companies. And REITs generally, by law, must pay 90% of their taxable income out as dividends, which is kind of sweet, as from an investor's point of view. There's two different main types of REITs. The first one, there are equity REITs and there are mortgage REITs. Equity REITs are companies that invest in actual properties. They'll buy apartments or houses and they'll manage them. They'll have renters, or they will renovate and flip these properties for profit. Whereas mortgage REITs, they they kind of buy mortgages like stock. They will buy mortgages and sit on them for the positive interest revenue that they generate, or like stock, they'll buy them low and wait until the prices rise so they can sell them for profit as well. Mortgage REITs, they usually focus on either the residential or commercial mortgage market. They don't usually are dabble in both, but sometimes they do. It's not as common. So pros to buying stock and REITs. As I already said, most pay 90% of their income in dividends, which is very nice to get dividends. They also help to diversify an investment stock portfolio. That's because when you buy a REIT, you're essentially investing in the real estate market rather than the stock market, and therefore these stocks, these REIT stocks, don't tend to follow the stock market trend as rigidly as traditional stocks do. And because they're stock and they're more liquid in nature than other real estate investments, they help to make your real estate portfolio a little more well-rounded. If you were to manage an apartment complex, or if you were into flipping houses, uh, you can't liquidate those assets as easily as you can stock, and because of that, they're more liquid and they're different. They diversify your real estate portfolio. And finally, they are less work than other real estate investments, such as flipping or being a landlord. And that's because they REIT companies, they have a manager that does all this work for you, and all you are is an investor, and he makes your money work for you. And now the cons to buying stock and REITs. Because REITs have to pay such high dividends, this a con is that management is forced to take out more loans in order to invest in the company. Um, some REIT dividends are taxed as ordinary income. That kind of sucks. So a lot of dividends, most dividends, they qualify for only a 15% tax rate. But there are many REITs that are taxed as ordinary income, which is a lot higher than 15%, or can be a lot higher than 15%. And obviously, this last point is self-evident. As the real estate market hurts, or as property values drop, so do your shares in REIT stock. So while there are, I mean, just like any other investment opportunity or whatever, there are cons to this to REITs, but there are a lot of pros too. I really enjoyed studying this, and I think REITs are pretty dope. And thanks for watching, guys, and I hope this was some help.